Hello, everyone. Welcome back to another episode of Spy Trader. I'm your host, Bull T. Barely, and it's 6 p.m. on August 2nd, 2024. We've got a jam-packed episode today with all the latest news and insights impacting the S&P 500. So let's dive in. First, a quick summary of the key news items making waves right now. Japanese stocks took a nosedive, with the Topix benchmark falling over 4%, largely due to expectations of further rate hikes from the Bank of Japan. Back here at home, the S&P 500 and Nasdaq futures are also in the red, following disappointing earnings reports from Intel and Amazon. Add signs of a softening U.S. economy, and investor concerns are growing. Unemployment claims in the U.S. have hit a nearly one-year high, and manufacturing is showing signs of contraction. All eyes are now on the upcoming jobs report, with economists predicting a slowdown in job growth, but expect the unemployment rate to stay around 4.1%. There's also growing speculation of 3 rate cuts from the Federal Reserve this year, up from the earlier prediction of just 2. Now let's dig into the analysis and insights. The Japanese market's reaction to potential rate hikes highlights the interconnectedness of global economies. Negative economic indicators in the U.S. can send shockwaves across the world, as evidenced by the plunge in Japanese stocks. Investor sentiment here is leaning towards caution. A survey indicated that 42% of investors expect a risk-off reaction to the upcoming jobs data, and analysts are warning that current conditions could be veering towards panic mode. The flight to safety is evident, with the bond market rallying and the 10-year Treasury yield dipping below 4% for the first time since February. Interestingly, commodities are painting a mixed picture. Oil prices are up amid geopolitical tensions, while gold hovers near record highs as investors seek safe havens. With all this in mind, what should S&P 500 investors do? Buckle up and prepare for volatility. The S&P 500 is likely to see turbulence as the market navigates these economic uncertainties. With tech stocks like Intel and Amazon showing vulnerability due to disappointing earnings, paying close attention to individual company fundamentals could be crucial. Here are my trading recommendations based on the current landscape. 1. Consider defensive stocks. Given the cautious investor sentiment and signs of economic slowdown, stocks in defensive sectors like healthcare, utilities, and consumer staples may offer some stability. These sectors are less sensitive to economic cycles and could provide protection against upcoming volatility. 2. Stay cautious with tech stocks. While tech stocks have been high flyers, the recent earnings disappointments from Intel and Amazon show they're not immune to macroeconomic pressures. It might be wise to hold off on adding more tech to your portfolio until we see some stabilization. 3. Look for buying opportunities in oversold stocks. Despite the doom and gloom, there could be opportunities in stocks that are oversold due to panic selling. Companies with strong fundamentals that have been caught up in broad market sell-offs might be worth considering for long-term gains. 4. Monitor economic indicators closely. The upcoming jobs report and other economic data releases will be pivotal. If the data is worse than expected, it could accelerate the shift away from risk assets, impacting S&P 500 valuations further. Being nimble and ready to adjust your portfolio accordingly will be crucial. Before I sign off, here's a little joke to lighten the mood. How do you describe an unethical stockbroker? As a bull in a china shop. That's it for this episode, folks. Keep your eyes on the market indicators and stay adaptable. Thanks for tuning into Spy Trader, and we'll see you in a few hours for our next update. Until then, happy trading.